Hey gang, so we have a very special video for you today. Today I'm going to talk all about my strategy, how it enables me to both scalp and also hold on to trades if the position gives us that ability. There's lots to cover. You're going to need to watch this to the end to get the full spectrum of how I do things. I'm going to be going through all of my indicators, what I use. Everything I use is objective, which means I don't look at subjective anything like EMAs or anything like that. I'm not interested in. I'm purely only interested in subjective data. So I'll explain what all of that means and why that's way more important. And then we'll get at it. So without further ado, let's get at it. Okay, so over in the charts, right, you'll see I have 10 different indicators. Now, if you're watching this on TikTok, you won't see those indicators. That's fine. We're going to go over that in a second. But on YouTube, you can see the indicators. So let's dive in, right? So if you look first, I have these 10 different indicators. I have the VRVP, qualified VWAP, weekly and daily separators. I don't actually use them anymore, so they can be removed. I have the news, and I also have range ruler. I'll explain what that is. The PVP, which again I don't tend to use too much, so we can ditch that actually. And then we have the VP-AA. I do use that a lot. We have the ICT kill zones, but I'm only using that specifically for what I would call the kill zones, right? I'm not really interested in the sessions because I use a much better one for that called Spaceman BTC levels. And then we have swing points. Now, first and foremost, you'll see a load of these daily VRVP lines. What they do for me is they give me levels without me needing to think about levels. And the reason they do that is if I extend this out here, this might change slightly, but if I look at the data, this is NASDAQ. Now, we've never been as high as this, right? This is kind of the height of where NASDAQ is at right now, so I don't really need to go beyond that. But if I bring up my VRVP, what this gives me is spikes, right? These are areas on the chart where most volume is traded. And so what does that mean for us? Most volume is traded. Well, that gives me insight into where I expect price to get sticky and consolidate, or a lot more orders will come into the market. So generally what we find is price gets slippy in between VRVP lines and price gets sticky at VRVP lines. So that's really a great way to kind of not have to focus on where we expect. And this is on the daily profile, by the way. So generally I would expect once we get round the VRVP line that will probably consolidate a little bit. That's just a little nugget of a bonus for you there. They're all just drawn. There's an element of subjectivity to it, but for me, I just focus on those lines where the actual line is higher. So if I go, if I want to add a new VRVP, I can just simply go add that there, right click, add it as a template. It's a VRVP daily. I have another line now, right? So they're just where the peaks are at the most prominent, because they're the interested zones that I'm interested in, right? Next, and I'm going to talk all about the strategy, everything, so don't worry, but I just need to kind of ease my way into this. So let's first talk about what it is I do as a trader. So I'm predominantly a scalper, but I do hold on to trades if they present themselves, and the way I do that is ultimately I use objectivity in my trading. So objectivity is really where there is no debate. It's a fixed level. It's levels that are only going to provide me assurance that something can happen at these moments in time. So let's start off and work our way down. I'm going to take the VRVP off for a second, and I'm going to zoom into the 1 minute. I'm in option R, and what option R does is just get you to that time frame. And this is on a Mac. I think it would be Control R on a PC. That will just allow you to get the natural zoom into where you want. So Right now, it's difficult to tell anything what's going on. I suppose I should start on the colours and what the colours mean. So, the colours, this is on the 1 minute time frame now. These are representing tick volume. So, if I look at a red candle here, I know that at least 300% more volume came in on that candle than the previous 10 candles combined. Sorry, not combined, on average. And so when I'm looking at these colours, it's giving me insight into what the market is doing in terms of the order book and order flow. Really powerful stuff. You know that generally a big sell-off will have occurred here. I mean, you could probably tell that without the candle, but we just know a lot of participants came in the market. Does that mean that price is going to continue down? Absolutely not. But what it can reflect is because we've been on a downward move, a lot of people are jumping in late, right? And they think that the price is going to fall and drop down. And so a lot more orders come in. And of course, what happens? We see a green candle here that represents buyers stepping into the market. If that was just white, it wouldn't reflect that average percentage of uptick in volume that would give me insight that actually we're protecting this level. Down here we have what is called CVD, cumulative volume delta. So what I'm using these things for is really to understand how cumulative volume is in respect to price. And so cumulative volume delta is really about aggression, right? It's aggression in the market. So when I'm talking about aggression, I'm talking about market orders, not passive limit orders. So what this represents is buyers or sellers trying to push price up or down, and it's relative to where the price is at. So let me give you an indication of what I mean. If I look here and I say draw a level, say between here and say here. Sorry, got that wrong. What this shows me is this level was lower than this level, but if I do the same here, you can see that this level dropped below that level. So we have a divergence, right? What does that tell us? That tells us that more aggression is coming into the market to actively push the price down relative to the actual price itself. So that was a good block, right? So that was where buyers actually stepped in, and the limit orders rather absorbed that value. So even though aggressors were coming into the market trying to push price down below where it was here, they couldn't push it beyond that certain point. And of course, what happens? Price then rejects and comes back down, and then we get another attempt. What can we see here? So I'm going to go from this line to that line. That's clearly moving down in terms of price. But what does CVD tell us at this point? Well, if I take that same point here and go to that candle, that tells us a much different picture. That tells us that sellers or buyers rather are starting to step out the way, right? Because look at the difference or the divergence between where price was here to there versus here all the way up there. That means it's not taken as ease of movement is probably a better way to put it, but it's much easier for sellers to push the price down because either the order book's starting to remove itself, you know, buyers are starting to step out the way, and price is unable to come down. So I use that as an indication of what the order book's doing and what the market's doing at any one time relative to that level. Now, then I have volume. This is just based on volume, and again, the tick volume is represented by colours based upon the last 10 candles. We can change that. We could have 20 candles, 50 candles, whatever we want. Because I'm a scalper, I'm only interested in what's going on the previous kind of 10 candles. So really good stuff to kind of get you in the zone of understanding volume spread analysis. That's essentially what it is, right? Understanding how much volume is being manipulated and what the actual order book's doing without being able to visualize or see the order book. So next we have what is called the qualified VWAP, right? Now, daily, weekly, monthly, quarterly, and yearly. If I take this back, this is the session, right? So the session starts here, and this is the current session. What am I looking for? What's important to me? Mainly, I'm a reversion trader, right? Which means I'm looking for a reversal. That's essentially what I'm looking for. What I'm particularly interested in is called outliers. right? Outliers. Outlier. This is a bell curve, right? And if I show you what a bell curve actually looks like, so you can see here, you know, this is a standard data set, right? So a standard data set just says to us, okay, if we take an example of data, let's say test results in school, just as a pure example, right? You might have, you know, the general mean, or the amount of people that get a C might be the mean, right? Or the actual center point. Now this for us is VWAP, right? So I want you to think about VWAP now, volume weighted average price, and then each one of these is a result that falls outside of that deviation or that standard set of data. So for example, you know, 1 standard deviation, 2 standard deviations, 3 standard deviations, and to the right we have +1 standard deviation, +2 standard deviations, and +3 standard deviations. So ultimately this data is saying, okay, if the data set of 50 kids in a classroom, because that's generally how many kids are in classrooms now, because they're all just packed in like sardines, when they're taking a test, we might say, okay, well, we expect the majority of people to get a C, right? But there's going to be outliers to that. You might get someone who gets an E or a D, right, at the furthest outlier. But the percentage of people that fail or get that low result is very low, versus the people that get A star, right, or you know, the highest mark that you can possibly get. It's the amount of kids. So if this was 20 kids, you know, 68.2% of them will generally get a C, right? And then as we come over, some might get a B, some might get an A, but a really small amount, maybe like 1 or whatever, might get an A+, right? And these are the ones who fail it. So a standard deviation is just a bell curve of data, right? So how do we use that to give us some value in trading? Well, that's exactly that same deviation bell, right? There's 0, or the center point, which for us is VWAP. Now this tells us, as price is moving up and down, the standard deviation tells us that actually for price to spend time in a band of say 2 or 3 is very low, right? Because we know it's way outside of true value, right? The actual value of what we'd anticipate where price likes to exchange, and that's usually around VWAP. Not always, right? Because VWAP is just volume weighted average price, but it tells us something important, that, you know, most traded volume and the acceptable price for trading, whether it's buying or selling, is usually around the volume weighted average price, because that means that most volume has been traded in and around that value. When we start to skip away from that, if you're selling when price is down here, then you're way below the value, right? Does that make sense? You're below the value. And so we use this, or I use this, to understand reversion, right? To understand how we can reverse price when price starts to come. It should come to no surprise that we start getting rejected when we're hitting this second standard deviation. But then we start to see mistakes happening on the order book, where people are, you know, smashing value down to these deviation levels, and then price, you know, starts to reverse. Now, ultimately, this is not to be used in singularity. It needs to be used in tandem with other key data, which is essentially what I'm going to go on to next, because as more volume comes into the market, these will expand and grow bigger. So just remember that and keep that in your mind. So what else? So I'm going to come on to news, but the next thing that I'm going to cover is kill zones. What are kill zones? So this is where we get into the philosophy of understanding what happens at different times within markets. So I'm always cognizant of session data. So for me, session starts with Asia, then London crosses paths with Asia, and then New York crosses paths with London. New York never crosses paths with Asia, and vice versa, but London has a mix of both Asia and New York. But these are called the kill zones. So these are generally perceived where most activity comes, and it's also where the different markets are opening up. And generally you start to see a lot more volume and moves that occur. Like you can see here, the moment this kill zone opens up in Asia, we had that nice big move up. You know, in London we've consolidated a little bit during this kill zone, so it wasn't the most valuable in terms of moves. But then when the kill zone ended, we had that push down. I don't really use the kill zones that much, other than just to know when they start and when they kick off. Where this becomes particularly powerful for me is with Spaceman. Now, I know this looks a little bit messy, but allow me to explain. I have a belief that price moves with purpose. It's heading somewhere for a reason, right? We have to think about liquidity and the importance of liquidity. So it's generally an accepted term that with liquidity for bigger institutions, when they want to make a move, they have to try to generate enough opposing orders. And what do I mean by that? Well, if they want to move price up, right, for whatever reason, could be a news event, could be just jockeying for positions, and they expect price to go up, then realistically they don't want to get in where price is high, right? They want to try to drive price lower. Where do they want to drive price to? Usually where liquidity's been in the past. Now they are things like session highs, session lows, previous day high, previous day low. What else do we have? Pivot points is another classic example of that, which we'll go on to in a second. But for me, it's very objective, right? Because once a level's created, it's created. That's the level. It doesn't require interpretation, doesn't require subjectivity. It just requires you to know where that level is, right? So what have I got? I have Asia high, Asia's open, and Asia's low. I have the previous day's high, but also New York's high. Don't worry about the New York, that's just the way the indicator works. We have Asia's low and London's low. On top of this, though, I also have, if I scroll down enough, we would start to see the previous quarter high, previous quarter's open. So we know the last 3 months, and then the monthly open and the previous month's low. So these are objective zones of liquidity for me. So my mind is thinking, okay, when price is moving and we're waiting for a kind of a keen reversal where we expect price to come back to, I'm always thinking, where's the objective liquidity? Where do we expect price to reverse back to? Or where do we expect price to target before that comes back? But the most important factor is, when we take an objective liquidity, are we expanded? Are we at a point where we are so far away from value that we should anticipate a very decent return? And when I say that, the difference being that I can scalp because I'm looking at order flow, like things like this, but I can also hold on to a trade if price is in this external zone. So for example here, what do we see, right? We see prices come down into that third standard deviation. We took the daily open, right, which was the overnight start here. Nice objective liquidity. And price is now starting to make its way back up to VWAP. That would have been a fantastic trade, right? Because we look at that, you know, we touched pretty much the third standard deviation. Lovely. That's exactly what we want to see, right? So that's just a really, without anything else, a phenomenal way to give us some insight into objective liquidity. Then what we want to do is add the range ruler. Right, what is the range ruler? I hear you say. The range ruler gives us some interesting data too, right? It gives us, let me see, gives us pivot points, right? So we can see here, these 3 blue lines, and I know things are getting a little bit squeezed now, but these 3 blue lines, this is the pivot point, this is the top of the pivot, bottom of the pivot, and then we have R1, R2, R3, and R4, right? All the way down by the monthly open R4. So what are pivot points? Pivot points are where kind of calculated steps done back in the day before any digital-based platforms were created, where the guys in the pits would just do a standard calculation and say, okay, let's do some ranges based on what we expect, based on the previous day's price. So they'll take the open, the close, the open, the high, and the low, and divide that by 3. and that will give them the pivot point for the next day, and then they will do other calculations that give them the R1 and S1 respectively. Really, really powerful stuff, because again, it's all about objective liquidity. I do not want to trade with my emotional set of subjectivity. What do I mean by that? Should I trade on the 9 EMA? Should I trade on the 21 EMA? Should I trade on the 200 EMA? These are all subjective, because I may use an SMA, you may use an EMA, someone else might use, you know, a Bollinger Band, whatever. These are all objective, these are all subjective, right? Because I don't know what the mass populace is going to use. Some days it might bounce nicely off the 9 EMA, some day it might completely disregard the 9 EMA altogether. I don't want to use that in my trading. Cut it out. I only want to use objectivity, because they're, for me, unilaterally accepted. As simple as that. It's just data that is accepted, and it's Asia's high is the same for me as it is for you, whether you like it or not. I want to use that. It's powerful. What else do we have? So I like to have the news, right? And what the news is will give me, if I go to the 30 minutes as an example, don't have any, we do have actually news. So these lines tell me that there's news events occurring. So you can see here, this, if I double click here, I can, if I want, show a table. And what this table gives me is tells me, okay, today, tomorrow, we have crude oil inventories. We have the upper house elections, which is red. So I know these are generally red letter days that can move the market, right? So that's important to me, because I know, you know, without having to know when there's a news event, that if I have a vertical line on the chart, that there's going to be a news event happening at that time, right? Really powerful. Just fit and forget. You don't need to worry too much about it. That's all good stuff. What's next? Things are going to look a little bit cluttered here, but just to bear with me a second, I'm going to go back to the 30 minutes. But session-based volume, right? So this is the session here. So I can tell. Let me maybe go to the 15 minute. It might be a bit easier to interpret. But this is the data point, right? So this is going to give me my the upper and lower margins of the session data, and then the point of control, which is this red one here. So usually the upper and lower margins is classed as what we call the what would you call it? My mind's gone blank. Just give me a second. If the point at the value area, obvious. It will give us the value area where most traded volume, that's 70% of volume is being traded. But again, these are generally accepted as objective liquidity. How do we react around the point of control? Most volume is being traded there. How do we react around the top of the value area, and how do we react around the bottom of the value area? I don't use these as much in my trading. However, they are still good to have when all else is giving you nothing else. And then lastly, I like to add on the swing points, right? So knowing where the swing points are for the upper and lower value in terms of that market. I mean, even on a smaller time frame, right? You know, I can see that was the low point, that was the high point. There's the new low point. And I imagine when we break this low, we'll have the high point there. So within you know, ease of me not needing to kind of draw out my levels, I know generally where the zone is, right, for your market structure. And that's just a key one that you get over time. And that's ultimately how I trade. So all I'm looking for really is exhaustion into a key level, right? Keep it simple. Wait for that exhaustion to be taken, whether it's a pivot point, whether it is a session high or a session low, whether it is a previous day high or a previous day low. These are the things. Wait for reaction. Are we in this zone of discovery here, which is really powerful and gives us that ability to get on a reversal, and then just let it go. It's as simple as that. It's exactly how I became live as a traded funder with Elite, trading this way. It takes out the nuance of knowing, what's my bias today? You know, am I an SMCT trader? No, none of that. You know, I think it's all over embellished, if I'm completely honest. Really, it's just about simple stuff, right? Where's liquidity? Where's price going? Are we exhausted? Is value true or false? Right now, we know its value is false at this point because there's a VWAP and we're so out of balance. Then that's a nice move, right? Does that mean that price is not going to come back into here? No, because what price has done is it's gone back into balance. Exchange of people taking the shorts. So taking the long. So if you've taken the long here, taking profit at your long as you're approaching VWAP, and then price can particularly get back in. So that's really all it was. You know, an insight into my world about how I trade. It might not be for everyone, but it is for me. Do you agree? Disagree? Anything that you would use that I wouldn't? And let me know. Let's get a debate going. Peace.